Well, good morning, everybody, and thank you very much for joining us. I am Kat Mann, and before I hand you over to Chris Liebertrau, who's one of the financial planners here at Nutmeg, he's going to talk you through the important things to consider when planning for retirement, as well as bringing this to life with some examples of how financial planning can help. There are a couple of housekeeping points that I just need to cover off. First, you may have noticed that we are recording this webinar today. And that will be because we'll be sending it out to those of you who have registered in the coming days. If you don't receive the email and would like a copy of the recording, then please do contact our client services team and we'll be happy to help. We are going to have time to answer any questions that you may have at the end of today's webinar. So if you think of any questions for Chris during the webinar, you can use the Q&A option in the toolbar, which should be at the bottom of your screen, and I'll pull those questions together and be putting them to Chris at the end. When asking questions, please remember that we can't provide financial guidance or advice on specific personal circumstances, although there will be details at the end of the webinar on how you can book a free call with one of the financial planners at Nutmeg, should you wish to. Questions should be focused on pensions and retirement planning, but if you do have any questions on the investments we offer at Nutmeg, our investment philosophy, or broader around, whether or not it might be right for you, then again, you can contact our client services or our wealth services team via email, live web chat, or good old-fashioned telephone call, and a member of the team will be more than happy to help you. Finally, I just need to say that anything we say today should not be considered financial advice, and it is not a financial promotion of Nutmeg. Your eligibility or suitability for any investment product or tax wrapper should always be assessed relative to your individual and personal circumstances. And of course, these circumstances may change in the future. The information that we're offering today should be used as an aid and a guide to decision making and not be relied on for financial advice. And with that out of the way, I am delighted to hand you over to Chris. Chris, good morning.
Hi, good morning, Kat. Good morning and welcome everyone to the Retirement Planning webinar with Nutmeg. My name is Chris Liebertrau. I'm a certified financial planner and one of the senior wealth managers here at Nutmeg. You've just been welcomed by my colleague Kat, who will assist in facilitating today's webinar. So just so you're aware, our presentation should be in the region of about 30 to 35 minutes, with some time thereafter for some questions. So what is retirement planning? So the goal of today's webinar is to try and give you a holistic overview of retirement planning and what this means, how to implement good behaviors, and we'll also explore various tools we use in this process to help you achieve what is most important to you. Now, firstly, a caveat. I know we have a wide audience here and we are trying to cater for everyone. So for some of you, this might be too basic, and for others, possibly too much detail. But we'll have time for questions at the end. So let's start off with a basic definition. Retirement planning, as defined by the Chartered Institute for Securities and Investment, is the planning we do in order to be prepared for life after paid work ends, not just financially, but in all aspects of life, including how to spend your time during retirement, where to live, and when to completely stop working. Please remember that people's perception of what makes good retirement is unique to them, so it is absolutely critical to identify your personal goals. So at Nutmeg, for instance, through our financial planning process, we'll take the time to get to know you as a client through a fact-find meeting. We'll understand all of your existing pensions and other investments, and any debts and liabilities, and we will use the cash flow planning to help us put together a personalized recommendation tailored to your goals. So what does your dream retirement look like? On a recently recorded podcast on financial advice, I discussed with Kat that wealth is a relative concept. Wealth is not necessarily measured by the amount of money in the bank, what cars you drive, or how many material possessions you own. Of course, an abundance of money makes daily living more convenient, but identifying what is most important to you and then achieving this in order to give meaning to your money is a more accurate reflection of genuine wealth. When we set out to build a retirement plan with our clients, we ask them a few really important questions to try and establish what their dream retirement looks like. The point of this is to try and encourage them to really get thinking about the things that are important to them, so we can then build a financial plan together and tailor our recommendations to suit their individual objectives. In this process, we'd ask questions such as, what does a comfortable retirement look like to you? What goals would you like to have achieved during your life? What is your main priority? Is this lifestyle or legacy, or perhaps you want a combination of both? What is the state of your health and your family history? When would you ideally like to retire? And do you know someone else that has retired well? And if so, what does this look like? And what aspects would you like to cherry pick for yourself? So you can see here that some of these questions might be thought-provoking. Perhaps some of them may even be uncomfortable to try and answer, but it really does get the ball rolling and spark the debate to try and establish what is most important to you and where you want to end up. So where do we start with retirement planning? So a lot of people think of their retirement as a future point of happiness and relaxation when I've stopped working. Things such as no more early commuting in the cold, like this morning, lazy mornings with cups of tea reading the newspaper, walking the dog, or spending time with your grandchildren. The fact is, planning for your retirement started long before this. For many people, this would have been when taking their first job and starting to contribute to a pension. For some, this is something that is a known quantity that has been checked and reviewed regularly. However, others might be more unaware or less interested. For example, it is not entirely uncommon for us to have an initial meeting with a client, and they mention that they have a pension, but have no real interest or understanding in what the values are, how it's invested, and what this could translate to for their retirement. So an important starting point for retirement planning is to clearly define your income as a household. Having a handle on what you have coming in each month is obviously important. For some people, this may just be a standard salary that is fairly fixed and constant and easy to plan for. However, with others, there may be multiple sources of income, rental properties, for instance, or more variable income as they are based on commission, or for those that may be self-employed. It's for this reason that it's also absolutely critical to establish what your combined household expenditure is. Something to consider would perhaps be setting up a budget, which can aid you in defining your necessary and discretionary expenditure. We certainly encourage this as good financial behavior, and there are numerous online tools and apps that can help you do this. In fact, some banking apps may already categorize your expenditure for you. From there, we'd also encourage setting up a balance sheet and establishing your assets, and then working out what assets are liquid. For example, ISAs, cash pots, or pension assets, and then what assets are illiquid and or lifestyle assets, such as residential property. On that balance sheet, you can also set out liabilities and when you can expect to settle these. It would be good to split this out between secured and unsecured debt. So secured debt is debt that's backed up by property, like a car or a house. Should you default on the loan or debt repayment, the creditor can take the collateral instead of opening a debt collection on your record or suing you for payments, as with unsecured debt. Examples of unsecured debt would be things like credit cards. So once all of the above has been established, you'd be able to define whether you have disposable income which you can put to better use in tax-efficient structures in order to build your investable wealth. So we often see clients putting together spreadsheets to try and map out their income and expenditure, and this can be hugely beneficial to get an understanding of where you are and how this is shaping for the future. However, it's difficult to implement inflation, growth, and tax assumption aspects to this. And this is where the benefit of cash flow planning can be hugely beneficial. So why is cash flow planning important? So cash flow planning involves assessing your current and forecasted wealth, along with money coming in and money going out, your income and expenditure. This enables us to create a picture of your finances now and into the future using a number of assumptions, inflation, investment, growth, in order to assess your current situation, match assets to the timings of liabilities, and recommend the best course of action for you to achieve your goals. So your financial journey in life is like setting off for sail across the ocean, but having a financial plan is like your compass bearing or GPS, pointing you in the right direction of where you intend to end up. There'll inevitably be headwinds, tailwinds, tides and waves that may push you off course, but with regular review of this plan, it can set you back on the right path. So how can cash flow planning help you reach your goals? So by visualizing different retirement scenarios, we can help you establish what your dream retirement looks like and what actions you can take to get there. You may want to consider things such as retiring earlier, taking more frequent holidays and traveling the world, or leaving a legacy, such as helping a child get onto the property ladder, funding your grandchild's education, or leaving a charitable donation to a cause that's important to you. The next part of this webinar, we're going to explore some cash flow planning scenarios based on a fictitious couple, Simon and Sarah Miller. We'll get into their details shortly, but in the next slide, I want to establish some base assumptions. So in this slide, we'll look at a set of assumptions that we use in order to build our cash flow plan. The source for all of this information is based on the FCA Prescribed Projections Report, which I've included a link to at the bottom of this slide. This is also referenced in the CISI Cash Flow Assumptions webinar presented in September earlier this year. So this report is prepared by PwC and reviewed every 5 or 6 years and then published by the FCA. As you can see in the highlighted section, the column second from the right, the FCA has a 2.5% inflation midpoint, and this is what we'll use as a default inflation assumption for our cash flow plan. A lot of you in the audience may well have seen the news this year when inflation hit the headlines as being as high as 10%. However, it is still the long-term target of the Bank of England to have inflation at 2%, and the 25-year CPI average is 2.1%. By way of example, it would take inflation remaining at 10% for over 2 years before the 25-year CPI average reached 3%, and just shy of 5 years of inflation at 10% for the 25 CPI average to reach 4%. So we feel that this is a reasonable long-term assumption. We then also have equities at 6.5%, or a real return in excess of inflation of 4%. Corporate bonds of 2.8%, or 0.3% real, and cash at 1.5%, or a real return of negative 1%. Right, so here we have Simon and Sarah Miller, at 50 and 49 respectively, happily married and enjoy working as this gives them a sense of purpose and fulfillment. Before now, they've been totally happily making their own financial decisions and have largely focused on paying off their mortgage, and now accumulate any spare funds into their savings accounts and premium bonds. They've really started to think about their retirement and what this could look like and whether their current approach is the correct one. So through this process, we've asked them to complete a fact find to give us details of their incomes, assets, liabilities, and expenditures, as well as their goals and objectives. And this is what they've provided us with. So they own their own home, roughly £400,000, and they're proud to say they finished paying off their mortgage earlier this year. In terms of their earnings, Simon earns £40,000 per annum after tax, and Sarah earns £10,000 after tax. Both Simon and Sarah expect to continue to work and earn their respective salaries, increasing with inflation from now until retirement. They have a combined annual household expenditure of £40,000. They're both entitled to the full state pension, and they have a mixture of flexible savings and workplace pensions, which we'll explore in the next slide. They both want to retire at age 60 and expect to maintain their current lifestyle. They aspire to travel the world, especially in the first few years of their retirement. They have 2 children, and if possible, they'd like to try and leave some sort of legacy to them. So the ONS life expectancy for Simon is 84 and 87 for Sarah. However, they mentioned to us that both of their parents lived into their mid-90s. As such, we have planned to age 100 as we'd rather plan more conservatively, within reason, of course. We feel it's better to have money left over at the end of life rather than to have life left over at the end of the money. Lastly, Simon and Sarah completed a risk profile questionnaire with us. This is a set of 10 behavioral questions which helps identify the acceptable level of risk they're willing to take. For example, it would ask questions such as how they'd feel seeing certain drops in the value of their investments. Both Simon and Sarah came out as having a medium risk tolerance and being reasonably concerned with volatility, which is the ups and downs in markets. Based on their answers, they are balanced in their attitude to risk and reward, and prepared to take some risk with their investments where this could result in higher returns. So here we have a summary of their total investable wealth. We've agreed with Simon and Sarah that we've not included the value of their home for the purpose of their cash flow planning, as we consider this a lifestyle asset. However, if they wanted to, they could of course look at a scenario where they downsize and liberate some capital from this if they so wished. We can see that Simon has a cash ISA of £100,000. Sarah has a further £150,000 in a savings account. They also have £100,000 in premium bonds. Simon's workplace pension is £150,000 and Sarah's workplace pension is £100,000. So with the cash and near cash equivalents, we've modeled 1.5% linear growth. Again, going back to that, it's inflation less 1%. And given their risk profile, we've modeled any investment pots, like their pensions, as a 60-40 portfolio. So 60% equities, 40% bonds. If we base that calculation on the FCA suggested assumptions in the previous slide, it would have a return of roughly 5.1%, or 2.6% real, i.e. above inflation. We've maintained this as a linear growth profile for their pots. So we've assumed for their current situation, any surplus income from their employment continues to accrue into their current account. So in this slide, we have a total of their investable wealth over time. You can see their ages along the x-axis at the bottom and the value of their investments on the y-axis. Each different shade of green represents their various flexible pots: current account, cash ISA, savings account, and premium bonds. And the different shades of blue represents each of their workplace pensions. So if all of these assumptions were to play out, this is what their total savings over time would look like in real terms. So that means in today's purchasing power. So as is depicted in the chart, they'd run out of money at age 95. You can see they accumulate funds until they're age 60, at which point there's a fairly steep decline and draw on their assets, but this tapers slightly when their respective state pensions kick in. This may not be the ideal scenario, as they also wanted to spend some time traveling during retirement and plan to give some money to their children. We have not factored any of that in, merely their standard living expenses of £40,000 per annum. Remember, of course, that they do still have the value of their home, though. So let's look at what could possibly be done in order to try and give them the type of retirement that they really want. In the next scenario, we've cloned the current situation and the assumptions remain the same. What we have then done is transferred the cash ISA into a stocks and shares ISA. We've invested £200,000 into a general investment account and maintained a £50,000 emergency cash pot. While they're still working, they have a £10,000 per annum surplus, and we look to invest these residual funds into a new personal pension in Simon's name. So we invest £10,000 net, which then gets basic rate tax relief of 20% automatically applied. It works out to a £12,500 gross contribution into his new pension. So a reminder, we've used 60-40 portfolio across their investments with the linear growth rate of 2.6% net. As such, the majority of their residual cash, as well as their surplus annual savings, now have a real terms growth assumption attached to it, as opposed to accumulating cash and losing value over time due to inflation. So as the cash flow graph shows, by deploying some of their capital into portfolios achieving a return in excess of inflation, it means that they have sufficient assets to maintain their existing lifestyle, their expenditure of £40,000 per annum. They'd have roughly £391,000 in today's purchasing power at their age 100, and this would comfortably be able to leave a legacy for their children. When compared to the previous example where the funds were depleted by age 95, it demonstrates that there is potential risk of too much wealth being sat in cash, yielding a below inflation return. The graph visualizes the numbers, and very often we can see the relief on people's faces when they realize they do have sufficient to meet their goals. So now let's look at another scenario where we increase their expenditure. Simon and Sarah told us that they're desperate to travel the world and during the early part of their retirement, and wanted to look at this as a specific scenario. We've therefore cloned the previous invest excess scenario so that all assumptions remain the same. However, we're then able to look at the feasibility of increasing the expenditure on their desired holidays during retirement. They told us in their fact find they expect to do at least 2 overseas trips per year and estimate that this will cost a total of about £10,000 per annum. So we've made provision for this between ages of 60 and 75, in addition to their standard £40,000 expenditure. So as you can see in this graph, the assets are now depleted at age 100. This should provide some reasonable assurance that their lifestyle will be comfortably maintained, as well as catering for holidays of £10,000 per annum in the first 15 years of retirement. So through this planning process, we've effectively shown them what is practically achievable and then gives them some options and therefore the ability to decide what's most important to them. They can realistically live this lifestyle with the extra travel, and they'd also be able to leave their home to their children. So for our 60-40 pots, again, we've assumed that 2.6% net linear growth rate throughout the investment cycle. However, our clients were also keen to see the impact of a significant market crash and what effect this would have on their investable wealth. As such, we cloned the invest excess scenario, so scenario 2, and at Simon's age 60, we replicated the UK index market crash and recovery between 2007 and 2012. This is the point where they have their highest capital value and will start to draw wholly from their investable wealth as they've stopped working. In this crash at its worst point, we saw a 34.91% fall in the value of their investments. And we can look at this impact on the next slide. So in this scenario, where we've implemented market crash and recovery, the client's assets are not depleted until age 94, and they still have the value of their home. Through this, we could then explore what other measures they could take, potentially such as tightening some of their household expenditure. Let's say the clients did indeed opt for scenario 3, increase expenditure. We would then look to model in which order and from which pots to structure their drawdown in such a way to maximize tax efficiencies. Considerations would include things such as accessing their pension benefits on a flexible basis to maximize tax-free cash, and also the potential to manage their income tax by taking advantage of their personal allowances. Other considerations would be capital gains tax and trying to wrap the GIA funds into an ISA, as well as on an ongoing basis, as well as potentially preserving pensions in as much as possible in order to mitigate inheritance tax, as these would not usually form part of your estate for IHT purposes. So what else do we consider? So our cash flow plan has been developed with information collected in our fact find, but also takes into account their risk profiles, which remember is a behavioral assessment of their attitude to volatility and risk. Volatility refers to the movements up and down of your investments over time. So this is a subjective assessment of what clients are prepared to lose. So we also analyze their capacity for loss. This is an objective assessment of what a client can actually afford to lose. So your ability to absorb losses without having an impact on your ability to meet your goals. In this, we'd consider things such as whether any guaranteed sources of income cover their necessary expenditure, and or whether a client owns their own home. We also factor in current investment knowledge and experience. So knowledge of products such as ISAs, pensions, GIAs, as well as experience of their investments having exposure to different types of assets, such as equities, bonds, commodities, etc. Lastly, we also look at their investment objectives or their need to take investment risk. As such, do they need to take investment risk in order to offset the effects of inflation, charges, and withdrawals to achieve their objectives and fund their lifestyle? So when it comes to investing, human psychology can often lead to behavior that can have damaging and lasting effects to your portfolio. In an ideal world, everyone would love to be able to buy at the bottom of the market and sell at the top. But in reality, this is rarely the case and effectively impossible to implement consistently. And getting it wrong can lead to a destruction of wealth. Building a robust cash flow plan and structuring your portfolio to cater for the timing of expected cash flows can help mitigate the effects of locking in losses during periods of market underperformance. So earlier we looked at a number of different cash flow scenarios that would then underpin any recommendations to how we would structure their portfolios to cater for their requirements. What we implement here is known as the cash flow bucket theory, and considers the timing of withdrawing from your investments. Think of pound cost averaging, but in reverse. So if you were wholly invested in high-risk assets, such as equities, this could pose a problem as to when you sell these assets to provide for your income requirements, as you may be forced to sell following a market correction, in which case those losses would become locked in. As such, we create 3 buckets for your investable wealth. Bucket 1 we'll call stable. So these assets should be solely invested in cash or near cash equivalents to provide the liquidity required for the next 1 to 2 years of your living expenditure. Bucket 2 we'll call prudent. These are any expenses needed within the next 3 to 5 years. So given these requirements have a slightly longer time horizon, the funds don't necessarily need to be as liquid as cash, and you can potentially take on an element of capital risk. These could primarily consist of bonds and other fixed income securities, and potentially some low levels of equity. And bucket 3 we'll call growth. So this bucket is expenses which are needed in 5+ years from now. The longer time horizon allows an element of capital risk. So it could be a multi-asset portfolio comprising mostly of equities and possibly some bond exposure to temper this. So by implementing this bucket theory, it means you've had a rolling layer of protection covering your immediate and medium-term expenditure and giving you a platform to invest the bulk of your wealth in growth assets which give you the best reasonable chance of a return in excess of inflation over the long term. The aim of this would be that in periods of good market performance, you replenish your stable and prudent pots from the growth pot. And in periods of poor market performance, you don't necessarily have to sell your equities and allow them the time to recover from volatility, thereby avoiding the locking in of these losses. So it's important to discuss this with the client in the context of their risk profile and capacity for loss. You want to ensure the client can stomach the volatility associated with portfolios with higher equity exposure. So for Simon and Sarah, they're still a number of years away from retirement and may not need to implement the bucket theory immediately, as they have the time horizon, given that they still plan to work for another 10 years, to absorb any volatility. As they approach retirement, however, and the income requirement from their portfolio draws nearer, this is something that they may want to consider. So for the purposes of this example, let's fast forward to age 60 for Simon and Sarah. After all assumptions and consideration of their circumstances, we've made a recommendation for Simon and Sarah based on the bucket theory of the following breakdown: £100,000 in cash, £150,000 in risk level 3 out of 10, and the balance £350,000 in risk level 8 out of 10. So what this looks like. So at Nutmeg, each level of risk between 1 and 10 is a decile of the equity exposure. So 3 out of 10 would have roughly 30% equity and 70% bond and fixed income securities, whereas an 8 out of 10 would have roughly 80% exposure to developed market and emerging market equities, with about 20% exposure to bonds. So our portfolios are globally diversified, and our fully managed portfolios have just over a 10-year track record. Our 8 out of 10 portfolio has achieved an annualized return of 6.57% during that period. It has, however, had a maximum drawdown of 25.66%. As such, the portfolio fell by 25% between 20th of Feb 2020 and the 23rd of March 2020, basically when COVID first hit and really affected capital markets. So although past performance is not an indicator of future performance, if you are in the decumulation stage of your life, this reinforces the need to have a robust plan in place and structure your portfolios correctly to ensure you're able to achieve your goals. So as mentioned earlier, remember that wealth is a relative concept and not measured by the amount of money in the bank, but rather identifying your major priorities and achieving these goals. This is a more accurate reflection of genuine wealth and gives meaning to your money. Retirement planning is not only considering your current circumstances and provisions, but looking beyond this and trying to carve out any goals and objectives that you have. Remember that in most cases, your retirement is a long time, and if you're lucky, often more than a third of your life. So when it comes to investing, human psychology can often lead to behavior that have damaging and lasting effects to your portfolio, and people can be their own worst enemies. So when investing for your retirement, it's important to seek advice to build a plan. Structure your portfolio in a way that allows that plan to succeed. Ensure that your portfolio is suitably diversified. So asset allocation, country allocation, managing currency risk. And keep an eye on costs. Costs eat away at your investment returns and can have a dramatic impact. And then review that plan and ensure that you're still on track and do not deviate unnecessarily. Okay, so thank you for joining me this morning. Really appreciate seeing so many people that took the time to spend with us. Really enjoyed putting this together for you, and I hope that you found this useful. Please note that at Nutmeg, we offer restricted advice on our own range of portfolio services and pension and investment products. If you do wish to have a further conversation with us, I've put a QR code here which you can scan with your mobile phone and will take you through to our booking page, where you'll be able to arrange a convenient time to have a conversation with myself or one of my wealth services colleagues. It's free to book a call, and there's no obligation to proceed with advice or with Nutmeg. If you're not that familiar with the QR code, you can of course head to nutmeg.com and book a call under the guidance tab on the main site. We'll of course have time for a few questions, so I'll hand back to Kat for this.
Thanks very much, Chris, and thank you for everything that you covered. We've got a couple of questions, and I want to start with this one, and I think it's a really important one. So for the majority of people, for a large number of people, a major uncertainty is the cost of residential care. So our question has come around subject to whatever the government decides to do in terms of potentially capping the cost or capping exposure. The cost of care can be around £50,000 per year. Is this something that we can factor in when looking at financial planning? How would you sort of suggest people start to look at that, given it is a considerable cost and quite concerning for some?
Yeah, totally. That's a great question. And, I guess in today's scenario, it was just meant to be a simple demonstration of how cash flow planning can work. Um, you know, when factoring in, this is something that we've discussed with clients, factoring in their state of their health and their family history. We'd look at, we could of course look at a scenario, for Simon and Sarah, for instance, where they perhaps scaled back some of their expenditure between ages of 75 and 85 after they're traveling and during their kind of slower years, but then kind of budgeting slightly more for ages, for care costs between the ages of 85 and age 100, for instance. It's definitely something that's hugely important.
Brilliant, thank you. Now we've had a question as well that's come in, and it's around whether or not it's worth starting a personal pension if you're at sort of 54 years old. Now I know, one of the things we often talk about is sometimes when it comes to your pension, the earlier you start, the better. What's the option if you've not got that time machine and you are at 54? Is it worth starting a personal pension then?
Yeah, totally. I mean, it comes down to obviously your personal circumstances. If you're still working, you're able to contribute your sort of pensionable earnings up to a cap of £40,000 per annum into a pension, and you benefit from basic rate tax relief and potentially any further tax relief you can claim back from your self-assessment tax return. Pensions, obviously, when you contribute, you get that tax relief on contribution, but you are obviously taxed on the way out. But it can be hugely beneficial, and when it's in the pension as well, it continues to grow free from interest income, dividends, and capital gains tax. Capital gains tax, there's recently been announced as well that there's going to be a bit of an attack on that, and it's coming down. So pensions, certainly a good place to build wealth into.
And can you just very quickly just to sort of recap on tax relief, and for those not potentially as au fait with the jargon, what we mean by that and why that's kind of a good thing to benefit from when it comes to your pension?
Sure. So, basic rate tax relief, at the end of the day, so you can contribute up to your pensionable earnings, and even if you're not earning, you can contribute. A basic example, you can contribute up to a maximum of £3,600. So that what you would do is actually contribute a net amount of 2,880, and the pension provider, so Nutmeg, for instance, will provide the basic rate tax for you at source. So you will actually see a net contribution of 3,600%. So the effective calculation is 2,880 divided by 0.8, and that is the 3,600. If indeed you are a sort of higher rate taxpayer, or you can contribute to that pension, and you can actually claim back any further tax relief from your self-assessment tax return, and HMRC will actually pay that out into your bank account.
Brilliant, thank you very much. We've got another kind of question on the personal pension, so I'm going to kind of group some of these together, but please do keep your questions coming in, and we'll try and get to as many of them as possible. Can old workplace pensions be transferred to a personal pension?
In many cases, yes, they can. So you sometimes would, so for instance at Nutmeg, you may just want to check if they have any sort of guaranteed annuity rates or safeguarded benefits is what the definition is. But in many cases, people can indeed consolidate assets at pension assets at a provider. So you would ostensibly be able to take 3 or 4 old workplace pensions that you may have from previous jobs and consolidate them all into one pension provider, in which case this makes for ease of administration. So it's certainly something that can be done, and at least it's easier to sort of manage and have a focus on where it's invested, your costs, that sort of thing too.
Thank you. I read something recently about the fact that the average worker will now have 11 jobs. So there could potentially, with the thanks to auto enrollment, have 11 pensions that you might want to be able to keep track of. We'll stick with pensions, although we do have a question about buy-to-lets, which I'll come back to. Where we've touched on tax, we've had a question about how is your pension income tax? So when you're drawing down your pension, what's the tax situation there?
Great question. So on the way out, so you've obviously had the benefit of tax relief on contribution and on the way in, and obviously the benefit of growth in effectively a tax efficient structure. On the way out, so when you reach retirement age, you're able to crystallize, at Nutmeg, for instance, we have flexible drawdown. So you're able to crystallize portions of your pension. And what happens is you can crystallize a portion of your pension. 25% of that will pay out to you as tax-free cash. The rest of it gets designated into a crystallized pot, and you can take income flexibly from that. So what we'll see sometimes is a scenario where people will crystallize a portion, take some tax-free cash, and use that crystallized portion to pay them out in income, but they can manage that flexibly in line with their other incomes. So for instance, we get a scenario where someone has retired at age 60 and they may want to take some income from their pensions at, let's call it £20,000 for instance, that they use up a lot of their personal allowance, and then they've got the remaining sort of roughly £8,000 being charged at basic rate tax relief and at basic rate tax of 20%. However, when they reach state pension age, for instance, their state pension might take up a lot of their personal allowance, in which case they might want to trim down some of their sort of drawdown from their pension to sort of mitigate their tax from that. So it's something that can be done like that, managed really flexibly. It's one of the major benefits of the UK pension tax system.
And that income, as you say, is sort of taxed in the same way your income essentially is when you're working. So if you're over those thresholds, which we're probably all quite familiar with now, your pension income or income you're taking in retirement is taxed in the same way. Essentially, it's income tax.
Exactly right. So it'll be taxed at source. So it goes through a payroll system with your pension provider. So they will actually pay the tax for you at source. They provide HMRC provide a code to them, and they take the tax. If you've been overtaxed within the pension drawdown that you've done, you can actually go and then claim any sort of additional tax back from your self-assessment tax return with HMRC.
Brilliant. Now I've got a follow-up question, which is on the sort of drawdown side of things and a little bit of tax. If on retirement you choose to go into drawdown, does the growth of the part that is essentially still invested, is that subject to capital gains tax?
No. So are you, sorry, could you rephrase that? Is it the pot that you've taken out as tax-free cash?
So the rest of your pot. So obviously we've gone in, you've taken a bit of tax-free cash, you've got some that is potentially remaining invested if you've left some in drawdown. Is the bit that is invested, is it subject to that capital gains tax that we know everyone's on the lookout for because the level is coming down?
So that's a great question. So the tax-free cash that you pull out, that then forms part of your estate and would potentially be liable for capital gains tax. We have a situation where some people will pull the tax-free cash out and then try and potentially get that into ISAs or something like that, in which case it wouldn't be liable to CGT. However, the remainder, so the tax-free, we'll ignore the tax-free cash, the remainder that sits in the crystallized pot, that's free from capital gains tax and interest income and dividends.
Perfect. Thank you very much. Now, we have also talked a little bit about income and sources of income when it comes to retirement. And we've had a question that how should we consider buy-to-let properties, or how should we consider buy-to-let when it comes to retirement planning? And I'm thinking there's possibly going to be an income implication here.
Yeah, totally. So income from rental properties doesn't count as part of your pensionable income. So on a cash flow plan, like we looked at for Simon and Sarah, what we would do is include that income as part of the income section, and you can actually see that over time, match it to your expenditure. But if, for instance, a person sold their buy-to-let property, we could look at a situation where we cease the income from that, but then have a capital inflow to their investable wealth and look at investing those funds, whether it be in ISAs or general investment accounts. But yeah, for the purpose of pension planning, those incomes from rental or buy-to-let properties do not count as part of your pensionable income, so you wouldn't get tax relief. You couldn't use that income to contribute to a pension and get tax relief from that.
Thank you very much. We've had a question here, and it comes back to that point around consolidating. And is there a good number or kind of recommended number of separate pension pots that we can have? The person, our viewer, has asked, multiple pots is complex, as we've already touched on. There's lots of admin that's involved with keeping track. But is there a sort of risk of only having one larger pot if, potential difficulties with a pension provider? Are you sort of putting all your eggs in one basket if you've got all of your pensions just in one place?
I mean, that's a good question. At the end of the day, sometimes it comes down to the complexity of what that person is trying to achieve. So someone can consolidate and have it all in one place. They benefit from potential fee savings, ease of administration, as we said. However, you could choose more than one provider if, for instance, you had multiple small pots and potentially wanted to do small pots payments. That's quite a complex thing, and we can get into that if that person has a particular question on that. But there's no set number. At the end of the day, what you want to make sure is that you have a diversified investment portfolio. So you keep a handle on costs, make sure that the sort of investment strategy speaks to each other, and you don't have two pension pots that are doing wholly the same thing and over concentrating. So you want to make sure that as long as you've got a handle on that and your overall strategy is diversified and in accordance with your investment objectives, that's the ideal.
Perfect. And I guess a kind of follow-up on this is there a maximum level of protection that you get per pension pot or per provider? In terms of, I guess, we're looking at things around financial services compensation schemes, or if the provider was to go bust. Sorry, when we're looking at protection, that's where we're looking at rather than the fluctuation in investments.
Yeah, sure. So at Nutmeg, for instance, we are a member of the Financial Services Compensation Scheme. So it would pay out to £85,000 per investor. But in reality, what we actually have, so those assets that you hold are in custody with State Street, for instance. So State Street is the custodian bank. So even in the unlikely event that Nutmeg were to cease operations, those assets would still be held in custody, and you would purely appoint another investment manager. So it's less sort of common in terms of how you would compare to sort of a bank asset, as it were.
Thank you. Now we've got a question, and I think we've probably got time for just one more, maybe two, which is asked, is there a case for having lots of smaller pension pots? The person who's asked the question, I understand that smaller pots of sub £10,000 are excluded from HMRC's lifetime annual allowance calculation. And I know we did a webinar on this earlier, so potentially an easier one to handle, Chris.
Yes, I mean, that's a great question. So the lifetime allowance as it currently sits is £1,073,100. However, as the person notes, those £10,000 small pots payments, so you can have up to 3. So it's effectively an extra £30,000 that can actually get added to your annual allowance, your lifetime allowance rather. My colleague Holly Graham, she did a lifetime allowance webinar. I'd encourage you to go and watch it. It's fantastic. But yeah, it would give you effectively it takes you up an extra £30,000 in terms of that annual allowance. And also when taking a small pots payment, it wouldn't affect your money purchase annual allowance. So if you take income from a pension, it would trigger the money purchase annual allowance rule, which means that you basically are limited to a maximum contribution of £4,000 per annum. So if you're still working, it can be potentially problematic if you still plan to contribute to a pension. Whereas if you take a small pots payment, that can alleviate the need for that, which is a fantastic way to allow you to still contribute normally if you're still working.
Perfect. Now I'm going to just do one more question, Chris, which I think sort of touches on a number of themes that we've covered. I am 55. Is it possible to crystallise the portion of my pension pot to the LTA limit and still leave my pension with my existing provider, or do I need to transfer it to a specific drawdown provider?
So Sorry, if you could just repeat that again.
Sorry, yeah. Is it possible, I'm 55, the person asking
Yep.
the question, is it possible for me to crystallize a portion of my pension for the tax-free cash and then leave my pension with my existing provider? Or do I need to specifically transfer to a specific drawdown provider?
I'm with you. It comes down to the actual provider. A lot of workplace pensions don't necessarily provide for that drawdown type facility. However, yeah, at Nutmeg you do. So you would be able to transfer the pension in, crystallize the entire amount, take your tax-free cash, and the rest of the pot can actually sit in a Nutmeg drawdown pension. You don't have to take income, but of course you can, as and when you do, on a flexible basis. So yeah, that's certainly something that's possible.
Perfect. Thank you very much, Chris. And thank you everyone for joining and for all of the questions. There's been some absolutely brilliant ones in there. And as a person who really loves a pension, I found that very exciting. I do know that there are some people who might have some more specific questions. So as Chris said, you can book a call with a member of the team. The call is free of charge and they will be able to help you. I know, for example, we had people asking about what kind of things might you want to consider if you're single rather than if you're as part of a couple. Those are all things that our team would be able to help you with, and so I would encourage you to do that if you can. Thank you very much for joining us, and we hope you have a lovely rest of the day.
Thanks, Kat. Thank you, everyone.